Good afternoon, and thank you for taking the time away from your families and your businesses during this definitely unprecedented and most challenging time to join us for this edition of Epic Insight. My name is Manny Marquez. I am the president of Epic Retirement Plan Services, and I will be your host for today's call. At this point, the CARES Act needs no introduction, as it has been dominating the headlines and impacting our lives both in and outside of the retirement plan world. We are most privileged this afternoon to be joined by Brad Campbell to offer some updates on the CARES Act, and also to answer some of the questions that have arisen now that we've had a few weeks to digest this new law. Many of you have submitted questions prior to the webinar, so I'm going to do my best to work through those, as well as any questions that you send us over the next hour or so. Before we get to that, I would like to welcome and also to thank Jim Wojak, Vice President and Senior Retirement Consultant at Federated Hermes, who has graciously offered to facilitate the conversation this afternoon. Jim, take it away. You have the floor.
Thank you, Manny. I appreciate that introduction. Again, I just want to echo Manny's comments there and say thank you. Hope everybody's doing well. Families are safe during these unprecedented times. I am the retirement specialist, or DCIO, salesperson for Federated Hermes. I cover the Northeast for our company. And I know that many of you on the call are familiar with Federated Hermes, but for those of you that are not, I just wanted to bring you up to speed with who we are. So a mutual fund company, we've been managing money since 1955, and really we got our start selling to trust banks and a lot of the companies that are on the line here with us today. Really, that was all before the onset of ERISA. So fiduciary is nothing new to us. It's something we've been doing for quite some time, and we really feel that we're an industry expert in that space. When we started managing money, we started on the short end of the yield curve, and through many acquisitions, we've built out our breadth of products that we offer to individuals, institutions, plan sponsors, and so forth. Today, we are up to $600 billion in assets under management, and we just recently went through a name change to reflect our most recent acquisition of Hermes Investment Management, a London-based shop that is also an active manager and has a big focus in the ESG world. So we are now Federated Hermes, and that's bringing us in here into 2020. Today, with us on the call, we have our outside counsel, Bradford Campbell, who is has been a long-standing partner for Federated. Brad has abundance of experience with ERISA. He served as the Assistant Secretary of Labor for Employee Benefits at the EBSA from 2006 to 2009 under the Bush administration, and has helped to write some of the regulations that I'm sure you're all familiar with, to include QDIA, 408B2, and many of the other ones that are out there. With that, I'll turn the call over to Mr. Campbell, who will walk us through kind of his thoughts on the CARES Act for sure, but then some of the other things that were already going to be happening here in 2020 with the Secure Act. And I think we're going to take a lot of this time to answer some of the questions that you all have as well. So with that, Mr. Campbell, I'll turn it over to you.
Well, thanks, Jim, and thanks, Manny, but more importantly, thanks to all of you for taking some time to delve into some of these issues. I know this is probably the 900th webinar you've been on in the last couple of weeks, probably just on COVID issues, not counting everything else. So we're not going to dwell too long on the prepared slides because we really want to get to your questions and a lot of the more creative issues that are coming up in implementation. But I think it's worth reflecting a little bit on what all is still out there and what's happening. I mean, this year, even before the virus, there was a lot of stuff we needed to deal with. We have implementation of the Secure Act, which I think probably the biggest issue there is the one that hasn't hit yet, which will be pooled employer plans and whether those become a game-changing option in the small plan space or not. There's a lot of potential promise for those, but as I talk to people who are working on implementing them, some of the folks are really enthusiastic about the opportunities. Others are looking at it saying, geez, we're not sure this is actually going to be a whole lot different at the end of the day in terms of the cost savings and the utility for plans. So that's all still out there. January 1 is when those can go live. What probably has changed is the timing we might get on some guidance related to not just that, but other Secure Act provisions, because clearly those are not on the front burner the way they would have been prior to the coronavirus. Then, of course, we have all the securities regulation issues. We got regulation best interest, Form CRS. The DOL may one of these days give us a revised fiduciary rule. The states are all trying to take over for the SEC and regulating broker-dealers. They're suing the SEC to stop Reg BI. They're putting in place their own fiduciary and best interest standards. And to top everything else off, of course, this year we were always going to have a presidential election, which, depending on which of the many candidates we were looking at, could have had wildly different views on what financial regulation should be, what retirement policy should be. That stuff is all still there, and it's all still moving along, albeit a little slower. Some of those things have been delayed, but it's all still there. And on top of that, we've now got, of course, the coronavirus. And so on the coronavirus, I like to divide the effects up into two categories. One is plans responding to the economic realities they're facing. And that means people are furloughing, laying off, terminating workers. It means they are looking at maybe suspending matching contributions. It means they've already got people trying to get loans and hardship distributions under the traditional rules, maybe even terminating their plans. There's all of those things going on. And really, none of the rules that govern how that works have been suspended. If you're going to make, for example, stop making a required matching contribution, there's timing issues on when you can do that. There are plan amendments you need to adopt prior to doing that. There are disclosure requirements that may be applicable that might require, 30-day advance notice. So there's a lot of those situations where making what I'll call traditional changes to plans require things to be done the right way. And right now we have a lot of people rushing to make changes that may not be doing all those things. So I think among plan clients, you all are going to be seeing a wide array of actions, some of which were taken in haste and not fully considered and now might have problems to deal with. That's one set of effects. The other is the new opportunities, what I'm calling the legal effects on plans. In other words, we have these new coronavirus-related distribution, loan, RMD options that plans can take or not, which they need to consider and make a decision about how to handle. So the two key things I think you're probably already seeing among your clients is, one, people are making mistakes that's going to be expensive to fix, and it'd be great if we could try to prevent some of those from happening. And two, plans need to be talking to their record keepers right now, because a lot of the issues, well, I'll boil it down into three basic questions. One, with regard to these new provisions, what does the law permit me to do? How broad is the scope of these rules in terms of implementing loan provisions and the new coronavirus hardship distributions? How broad can I go? What's legally permissible? Two, what do I actually want to do? Does our plan want to do this? And if we do want to do it, to what extent do we want to mesh the loan provisions in with our existing structure? And how does it apply to different categories of workers, whether they're on unpaid leave or whether they're terminated? And all of those questions about how to structure it. And then three, separate from what we could do and what we want to do, what can we do? What is actually possible with our record keeper and other vendors to set up these programs and administer them? And so those are all issues that are confronting plans right now. So again, you probably heard the basics, so let's not dwell on it excessively, but these new coronavirus-related distribution options are much more permissive and easy to administer than existing hardship withdrawal provisions or other distribution options. Plans get to decide whether to do this or not, but you get up to $100,000 distribution from a participant that does not trigger an early withdrawal tax, so no 10% for under 59.5 additional penalty tax. The person taking that distribution can ratably treat it for tax purposes over 3 years. In other words, I don't have to realize that full $100,000 as income this year. I can roll it over 3 years. I shouldn't say roll it over, take it as income over 3 years for tax purposes. Or alternatively, I can roll those funds back into my retirement plan that they came from if the plan allows. And that's another factor plans need to think about. Are they going to allow that? Secondly, could I put it in, I could maybe then put it instead into an IRA or into a new employer's plan. So there's some real beneficial tax treatment for the participant. For the plan, the reason this is easier to administer is unlike a traditional hardship distribution where the participant has to have already incurred the expense and then show grounds as to why this hardship should be granted. You don't have to question the amount. You don't have to question the need as long as the participant is self-certifying. And it'd be good to get that in some kind of documented form, of course, and talk to your record keepers about how best to do that. But as long as they're willing to sign on the dotted line, so to speak, that says, hey, I'm eligible because either I or my spouse or dependent have coronavirus, or I've suffered adverse financial consequences, which can be as broad as I had to miss at least a day of work because my kids aren't in school and I had to take care of them. You, the plan, don't have to be the traffic cop here. You can just rely on them saying, yes, I'm eligible, and rely on the amount they want to take out. And as long as that amount is less than 100,000 and in the account, they get the distribution. So that's much easier to administer, a lot less pitfalls for the plan, and preferable tax treatment for the participant. So the distribution provisions, I think, are pretty straightforward in many respects. The loan provisions, I think, are actually far more complex and trickier than maybe people have been giving them credit initially. So it allows you to have a new coronavirus loan that can be up to 100,000 instead of the 50,000 before, and there's no collateral requirement. So you don't have to have half of the account value still in the account. You can also suspend the loan payments from April through the rest of the year, in effect. So that just is sort of a holiday on making loan payments, and the only real effect is that the lost interest in that period, well, not the lost interest, the interest that accrued in that period needs to be reamortized over the remaining loan when the payments resume. It has the same eligibility that in order to get this coronavirus loan, you have to have met the eligibility requirements that are the same as the distribution. There is a little technical wrinkle here, though, that the statute incorporated that definition by reference, and it didn't quite reference all of the right parts. So the reliance on self-certification is not expressly written into the loan provision the way it is to the distribution provision. There's ambiguity there, and depending on which record keeper you talk to and which lawyer you talk to, you'll get a slightly different answer as to whether they're going to go ahead and allow self-certification in the loans. I've seen a lot that are allowing that on the grounds that it probably was the intent. It's not 100% clear you can't do it, and it may solve a lot of other problems. In other words, what's the risk the IRS is going to hassle us about relying on a self-certification, a year from now, compared to the risk and hassle that will result from a participant who's been denied a loan raising, Cain about it right now. So for all those good and practical reasons and the ambiguity in there, I think we're seeing a lot of people who are taking the view that the reliance on self-certification, rather, can also be used for the loan provisions. The reason I say these are trickier is there's a lot of other things to think about here. If the plan only allows one loan, you have to look at increasing the number of loans that are available if you want the coronavirus loan. A lot of plans currently don't allow loans to be given out to someone who's been terminated. So if your employees are furloughed on unpaid leave, but still employees, that might affect their eligibility compared to having been terminated from the employment entirely. You may want them to be able to get a loan, even though they've been technically terminated, and that may or may not be something your record keeper can do. Similarly, when a person leaves employment, is that going to trigger a repayment obligation and ultimately a deemed distribution? And is that something that your record keeper can work with you to either avoid or make alternative arrangements for? Those are all issues people need to think about. And I'll throw one other thought out here that we've been kicking around with some clients, which is, if I've got a participant who takes the distribution option, assuming I offer it, they're getting some preferential tax treatment. If I have a participant who takes this new loan option, borrows $100,000, and next year has to start making those payments on it for the first time, and they now realize the loan payment may actually be bigger than my paycheck because I borrowed $100,000 for 5 years out of my plan, we're probably going to have a lot of loan defaults on those loans. And if there's a default under these provisions, then all that income is realized in 1 year, not 3, and the 10% early withdrawal penalty could apply for somebody who's under 59 and a half, whereas it wouldn't have with the distribution. So there are some things to think about here as to which is preferable for a particular plan sponsor's workforce. And based on the ability, likelihood of repayment, based on whether people are actually out of work and need access to it, there's a lot of factors that need to go into thinking about what to do here. And downstream, I think we're all going to be experiencing a lot of questions and problems from adopting some of these. I say that not to discourage doing it. There's a reason Congress put these in place, and there's some real benefits to participants who need money. I'm just saying there's a lot to think about here beyond what's the bare bones on the page. And that might be some of what we talk about in some of the upcoming questions. Lastly, and then I'll stop talking and we can get to what Manny wants to talk about and what you all want to talk about. You also have the option of suspending RMDs, required minimum distributions, for 2020. And that is kind of the flip side of the other. While the first two provisions are all about letting people get access to funds, this one is about letting people deny themselves access to the funds and not lock in a potential loss in a volatile marketplace. Some issues have cropped up there about what happens to somebody who already took an RMD, which is spaced out over, say a monthly distribution. If they already took it in January and we're past the 60-day window, and the law didn't pass until March 27th, how do they deal with that distribution, which they'd like to not have taken, and which the law says they didn't have to take, but realistically they already took. So there's some practical issues to work out there. The very last main provision for retirement plans deals with defined benefit plans, and that may not be as big an issue for a lot of you, but think about some cash balance plans you may have put into place. The funding percentage, basically the funding that you use for calculating how much underfunded you are, Congress is going to let you use last year's numbers instead of this year's because of all the volatility. And secondly, you don't have to make a minimum payment this year until next year. What I should say also, the last thought, and then I'll stop talking, Manny, I promise. The last thought is the RMD distribution and loan, the COVID-related RMD distribution and loan, all of those we have until 2022 to make retroactive amendments, which is actually supremely beneficial here because we're going to have people that make mistakes. We're going to have weird situations. We can see what happens and then write plan amendments that will fix those problems and justify some of the things that happened that maybe weren't intended. And we have a year and a half to do that. So we're going to be able to clean up some messes through good drafting of plan amendments after we see what happens down the road. And that's going to be a big advantage to preventing some problems. And again, contrast that with the non-coronavirus related plan provisions where you might have to do an amendment now to change a plan as it's currently written. So keep in mind, there's two different timeframes for plan amendments, depending on whether it's coronavirus or not. If it's coronavirus, we have a long time to fix it. If it's not coronavirus, you may have to do the plan amendments right now to address a particular need. And with that, I've probably blathered on long enough, Manny. Let me turn it over to you and go from there.
All right, thank you, Brad. I'm going to try to do my best to bucket the questions as best I can between distribution, loans, R&Ds, and then probably everything else. There's quite a few questions that have come in on taxation issues, so I'll ask you those as well. But before we get into that, as far as the plan sponsor or the plan fiduciary that has to make a decision on behalf of their plan to adopt or not adopt these provisions, is this a package deal, or can they pick and choose what they want to adopt and what they want to pass on?
Yeah, so there's, generally speaking, you can pick and choose. For example, you could do an RMD and a loan. You could do just the RMDs. You could do just the distribution. And within the loan, for example, you have a lot of latitude in how you want to structure things. Obviously, there are certain elements that are built into the statute, but there are others where you have a lot of flexibility. So that's why I say on the back end, the plan amendment is going to be somewhat flexible to address things. But indirectly, you alluded to something I think we ought to clarify, which is the decision about what does my plan look like when I as an employer decide to offer a plan, or when I as an employer decide what type of plan to offer and what its features are, like do I offer loans at all? Those are settler functions, meaning they're decisions I make as a company in my company capacity, not in my fiduciary to the plan capacity. They're sort of pre-fiduciary decisions. They're what are our benefits going to be as an employer decisions. And that's where these decisions to adopt these COVID provisions actually lie. They are not fiduciary decisions, they're settler decisions, which has two implications. One, you're able to make these decisions as an employer, not acting solely in the best interest of the participants, which is an important distinction. Two, if you're expending any funds in relation to making these decisions, let's say you needed to hire a consultant to do a study on something, that cannot be paid for out of plan assets because it's a settler decision. So the fiduciary part and the part that you can use plan assets for starts in implementing the decision that the plan sponsor has made. So once you've decided, yes, I want the COVID loans, or yes, I want the COVID distributions, and you start negotiating with your service providers on how to implement them, implementing them and paying for them at that point is a fiduciary decision and a valid plan expense. But before that, it isn't. And that's just an important distinction I think plans need to make sure they understand.
Brad, a follow-up question on that comment came in around who is making that decision. As you, I think, pointed out a couple of weeks ago, some plan providers have decided to default plans into these provisions unless they get an election, so sort of a negative consent, while others have decided that they want an affirmative answer from each employer. What's your position on that?
Yeah, so that's a great point. So first, who's making the decision? From an ERISA perspective, I don't actually care in that that's an employer function. That's you, the company, deciding what are our benefits going to be. So whether that's the board of directors, whether it's the head of HR, whether it's the CEO in conjunction with some other officers, decide what you want the plan to look like. That's an employer function. So it doesn't have to be the plan committee making that decision, although they're going to need to be the ones who implement it. But as you say, one thing that the plan committee does need to be aware of is, you made a great point there, Manny, some record keepers sent out notices really early on at the very end of March or first part of April saying, hey, unless you tell us you don't want to do this, we are going to proceed in allowing coronavirus distributions on the following terms as an amendment to your plan service, to your service agreement. So unless you tell us no, we are going to treat this as you deeming consent to the change, a negative election process. And that's probably kosher. I mean, we can argue about the details of how much notice was given and so forth, but by and large, that's probably a technically legal way for them to do it. It wasn't universal. A number of other record keepers want you to sign on the dotted line and say, yes, we want this, or no, we don't, not, you're going to get it unless you say no. But in either event, the plan committee needs to be talking to the record keepers to figure out what they're doing and how. Because again, I'll go back to there's what you could do, there's what you want to do, and then there's what you can do. And that last one, you won't know until you spend time with the record keeper. So now is not a time for folks to be ignoring notices they're getting from the record keeper. A lot of that's probably vitally important and timely information.
All right, I'm gonna try to cover as many of these distribution questions that came in. They seem very straightforward. Can a participant take a CRD because the spouse was laid off?
Yeah, we believe you can. The guidance or the statute and to what extent there is any guidance are both pretty vague. It basically means have you suffered an economic hardship, and these are the kinds of hardships there are. We tend to view them as ones that would be applicable to a household. But more importantly, and I think this is something plan sponsors ought to think carefully about, you don't want to put yourself in the position, in my opinion, of having to try to second guess the participant. They can self-certify. So put down a list that says, sign on the line indicating you meet one or more of the following criteria, and then just list the criteria from the statute, and then they sign on it, and you don't have to question it. That's far preferable to trying to think through all the possible ramifications and say, well, gee, are you sure? Was it really your spouse? One, we think your spouse would qualify as a adverse economic effect that would affect you, absent guidance to the contrary. But two, we just don't think plan sponsors ought to put themselves in the position of trying to get to that level of detail. Let them self-certify and move on. It's a lot cleaner.
Can you take a CRD from a qualified plan, a 401k plan, and then roll that money over to your individual retirement account? And if you do that, what is the process? What's the paper trail that you would have to follow as a participant to do that?
Yeah, so you can do that. We've gotten this question before saying, well, wait a minute, the way this works, if I take the distribution and I use the option to roll the money back in the next 3 years, can I only do it to the plan it came from? And the answer is no. In fact, the plan it came from may not allow that. That's still an elective thing. Plans can decide whether to accept roll-ins or not. But you can roll it over to any other qualified plan or IRA that you're able to do. So you should be able to roll it into an IRA. Now, in terms of the paper trail, I think this is one of those questions that's kind of evolving. Is the institution that's receiving a roll-in proceed for a rollover for that IRA, are they going to question where it's coming from? And right now, in the ordinary course, there's actually a self-certification letter that you could send to an institution related to a rollover that would say the 60-day rule isn't applicable, and none of the elements there directly match up with coronavirus. So is it possible we're going to have some bumpy roads ahead on some of the documentation for roll-ins? Yeah, it is possible, but the paper trail should work. You should be able to show that I got a coronavirus distribution, and that coronavirus distribution designator, so to speak, really ought to make it clear that it's good for 3 years instead of the usual 60 days. Will that mechanically work as simply as that? Almost certainly not. And we'll work through some of those as they come up.
Yeah, this question is I think you partially answered it, but what mechanism allows you to pay it back without triggering any sort of taxable event?
Well, so the taxable event, okay, so we're taking a coronavirus distribution, which is a taxable event ratably over 3 years, which means in year one, I have to realize a third of that as income. Well, let's run through this hypothetical. Let's say I took $100,000 out. Year one, I paid taxes on $33,333. Year two, I paid tax on another $33,333. But in year three, I managed to scrounge together $100,000 and rolled it back into the plan. Would I be allowed to recharacterize that money I've already paid taxes on as a roll-in? On the bare bones of the statute and absent IRS guidance to the contrary, I'd say yes. But what about the fact I've already paid taxes on this for 2 years? Well, I think at the end of the day, what's going to happen is you're going to have to amend your returns for those 2 years you paid taxes, reflecting what happened in year three. But those are the kind of questions probably the IRS will have some views on when they have time to think about it. The bare bones of the statute are really pretty bare here. You have 3 years to do a distribution, to roll back in a distribution, and it does not say ratably roll back in a distribution. So theoretically, on the last day of year three, I should be able to repatriate $100,000 back into my plan. And yeah, that's probably going to result in me having to unwind a bunch of taxable events that previously happened, but I ought to be able to do that. That's all looking ahead pretty far, though. And I got to say, I think we probably need to focus more on how do we get these programs set up in the first place rather than the long-term tax consequences here in April.
Yeah, so I'm going to skip. So you sort of answer a bunch of questions that came in around taxation of the distribution, Brad. So, how it's done, whether it's, a third in each year versus what you basically just said, that you can wait and do it all in year three. Unless you have anything else to add.
Just to be clear, the taxation has to be done ratably over 3 years. So realizing the income from a distribution is ratable, the right to roll it back in doesn't say ratable, so, or ratable, however you pronounce that. So we look at it as the repatriation of the funds could happen at the all at once at year 3, but the taxation, the realization of the income has to happen evenly over 3 years.
Exactly. Let's talk a little bit about loans. As you said, those are a little bit more, there's some nuance to how loans are being dealt with. If I took a loan earlier in the year, so let's say, January 2020, can I now elect to have those payments suspended?
Yeah, so the payment suspension is not limited just to newly initiated coronavirus loans. It can apply to all existing loans. So that's something that can be applied much more broadly. And something else I didn't mention when I did the first run through, at least I don't think I did, that is relevant and kind of somewhat related to that question, is that the 12-month look-back rule still applies. That wasn't waived. So just as currently the amount that I could borrow from my 401k, for example, is reduced by outstanding loans I've had within the past 12 months, even if they've been paid off fully, that still applies. So if I had a $20,000 loan that I paid off in December, that's still a $20,000 loan I had within the last 12 months. So it reduces the 100,000 I can borrow down to 80, just as it would if it were an open loan of 20,000. So there is still some interplay there with the look back rule that further complicates the loan provision.
And if the participant is terminated, I'm assuming the participant was terminated and was making loan payments, can that participant also suspend making the payments?
Well, that's a really interesting one. So I think that's where we'd have to be pretty creative with a plan amendment. So if your traditional plan, and it probably does, although it's not 100% universal, but your traditional plan probably in many cases says, hey, when you're terminated, this loan is now due. So chances are, if that termination occurred before March 27th, that you may not be able to work that into this at all. If, however, that termination occurred after March 27th, you may be able to write the amendment down the road, the one that's due by 2022. You may be able to write the amendment in such a way to indicate that someone whose loan was terminated after March 27th is in deferred payment status because the final payment was due in that period. And you could even argue that termination doesn't trigger a repayment requirement, but in fact allows the loan to continue. But again, the question there is you're going to have to talk to your record keeper about whether they can do that or not. So I think you're going to have a number of questions focused on what about payments and loans for people who are terminated employees, and how does that blend in with this deferral period? I know that's kind of a wishy-washy answer, but that's one that's so specific on the dates and the facts. Bottom line is I think someone where an event like that happens after March 27th, you're probably going to be able to rewrite the plan amendment retroactively to address it if you want to. And that's one of the questions is, are you going to be aware of those problems and think about how to address them and talk to your record keeper about how to address them? Not all record keepers, many record keepers actually are not going to be able to have a separated vested participant who's no longer an employee continue to make payments on a loan. So while this issue can be deferred for a while because we have deferred payments, so someone that I didn't lay off until April 15th, maybe I don't have to worry about the details of when their repayments and separation issues triggered because technically they wouldn't have to make a payment until January, and we have some time to sort that out because of the deferral period. It is something you're going to have to look at and sort out. So I think the conversations with record keepers are going to be, I think, pretty complex on, yeah, we want the loan provision, but what does that actually mean in how we implement it for our plan, given what happened to some of our participants and given when we laid people off versus when we terminated them and the effects that had on their loan.
To stay on this subject of loans and plan amendments, amendments now versus amendments in 2 years, what if the current loan policy within the plan is very specific? The plan only allows loans for certain reasons like hardship. how would they treat this CRD loan potential?
Yeah, so you're going to have to decide how you want to do it. You could either have two separate loan programs, your normal quote unquote traditional legacy loan program, which is operated in exactly the same manner, or you could incorporate the changes of that into this coronavirus loan program and fix that. So under the normal approach, if I wanted to change that program, I probably need to adopt a plan amendment. But to the extent it's part of the coronavirus related loan, then I have a lot more time, as you say, until 2022 to adopt the amendment. So I think practically speaking, what you'd want to do there is say, we have our own loan program, our old loan program, which has all these specific rules. If you wanted to use that, it's still technically there, but realistically, your loans are going to go through our new coronavirus loan program. And our plan is going to be retroactively amended to allow those to exist side by side or subsume one into the other. But in either event, you could write it in such a way that all the things you want to have happen under the COVID program would happen. So that you wouldn't be limited to the old hardship distribution or the old single loan at a time rule under the new program.
Let's talk a little bit about RMDs. This question has come in now five different ways. So is the RMD waiver a statutory provision, or does it have to be implemented by the plan? And we're hearing all kinds of different things around that.
Yeah, well, the answer is it's both. It is a statutory provision in that it's in the statute as something you can do, but it does need to be adopted as a plan amendment. And I saw one of the questions where somebody said our platform provider says we don't have to adopt an amendment. That's not how we read it. The statute gives you the same until 2022 time period to adopt an amendment to address it. So we read it as, yeah, you'd need to amend your plan to provide for the RMD provision as well. But again, you have this very long time period. So in practice, you're going to go ahead and stop requiring RMDs. You're going to be able to, unwind those issues. And then, a year from now, look at it and say, okay, how did we do that? Now, what do we write to make sure everything was covered? But yeah, you do have to do a plan amendment eventually to justify the RMD provision.
So I guess this question, not necessarily about RMDs, but about distributions in general, is sort of related, if you will. In order for a participant to take advantage of the favorable provisions, the no 10% penalty, the election out of withholdings, the rollover opportunity, all of those things, does the plan have to offer it, or can a terminated participant say, claim that was his distribution, even though the person may have left before March?
Yeah, this is one of those where technically the plan is going to have to make that available. Now, timing here would matter. So let's say the plan didn't decide it wanted to really do the hardship distribution at the same time that person took a regular distribution. Could I recharacterize that distribution under the hardship provision I eventually adopted? And the answer could well be yes, because you're retroactively approving a plan amendment as of, I believe, March 27th. So let's say a participant took a regular distribution on April 2nd before you had really formally figured out how to do the COVID distribution. But down the road, you said, okay, all distributions from March 27th on for anyone who's eligible is going to be a COVID distribution with all these favorable rules, and that person is willing to self-certify. You should be able to adjust that to cover that individual. Now, if there's already been withholding, no, I don't think you're going to be able to get that money back to the participant, but they can address that when they file their tax return for that year and show that it was a valid coronavirus distribution and withholding should not have been taken. So I think there's going to be ways to address some of the ramifications, but it is going to require, back to your first point of that question, it is going to require the plan to have adopted a coronavirus distribution amendment that would cover the activity of that individual who had taken that distribution technically before the plan had really done it, but within the window of the time during which the plan could have done it. That was a really convoluted answer. Did that make sense?
It did.
Okay.
Talking about liability, I know you alluded to this earlier. A couple of questions came in, and it is already determined that this is not fiduciary liability, but still, folks are wondering. Number one, do you ascribe any liability to the employer around the certification issues? And number two, do you see that there's any responsibility here on the employer side to educate participants around the impact of a withdrawal or a loan default later in the future?
Yeah, so let's take the first of those. So this is a employer decision in offering benefits. So is there some basis for liability? Well, I mean, if you have a collective bargaining agreement where this is part of what would be covered by that, so you need to talk to the union about something, and if you didn't talk to them about it, could that be a problem? Sure. There's a lot of those kinds of issues related to the employer acting as an employer. Those really would be outside of ERISA. For ERISA purposes, there really shouldn't be any liability for making a decision one way or the other to adopt these plan amendments. There is liability for implementing them, as we discussed, but not for the decision to do that. So, I can't guarantee you won't get sued, because all it takes is a lawyer with what they call a colorable argument, which is pretty weak, and a filing fee, which is a couple $100 to bring a lawsuit. So it's not like the barrier is that high. But is it a credible lawsuit? Is there a realistic fear of liability here? I don't think there is much. To your point about education, okay, the new coronavirus distribution loan and other provisions don't have special disclosures or deadlines or so forth that need to be communicated in certain ways. That said, is it probably a good idea to give basic factual information about, for example, the tax consequences of a distribution under this new provision versus a loan under this new provision? Yeah, it probably is, but you're going to need to be careful that you're just providing factual information that's not leaning towards a recommendation. So I think, is there a requirement to educate? No. Is it a good idea to provide basic facts about what's happening? Yes. But be careful that you provide accurate facts and you're not actually shading into recommendations. But man, if I can go off on a quick tangent, because I think it's worth repeating, we really, as plan sponsors, even though this isn't a fiduciary decision, I think people really ought to take a second and think, how likely are my participants to default on these loans? And would they be better off taking a distribution over a loan if they're going to default on the loan and trigger more punitive tax consequences than if they ended up keeping the distribution? I think it's something to think about. Ordinarily, a lot of advisors would say to their clients, hey, let's make them exhaust loans before they go to a distribution option. And I know there's now some limits on the Secure Act not Secure Act, previously. There's some changes about how that works, but a lot of times people look at that as a good idea. Loans first, distribution second, because our goal is to preserve plan assets. Here, we're really letting leaving the barn door open on preserving plan assets. There's already going to be a giant exodus in response to these. If you're willing to do that, it's probably worth thinking about, is the loan actually potentially a bigger problem for a participant than the distribution? And I just think it's something to bear in mind, even though it's not technically a fiduciary question that you have to resolve.
Brad, I would like to pivot. There's a number of questions that have come in, over 10, that I can read real quick, around PPP and what that money can be used or not used for, including obviously, pay for the salaries, with elective deferrals, with match money, with safe harbor contributions from the employer. How far back can you go to use that money? So do you want to comment on that? And then I'll try to ask you very specific questions that are coming in around just different things related to PPP.
Yeah, so first of all, the statute and the regulations that the Small Business Administration put out, and some later guidance from SBA in conjunction with Treasury that came out, I think, April 6th, they don't tell us as much detail as some of these questions are likely to get into. But we do have some general guidelines as to how this works that we can interpret from. Just so we're all on the same page, the general rule is if you're getting one of these small business loans, if you use 75% or more of the proceeds to meet payroll costs, as that's defined under the regulation, then that loan will be forgiven if you keep all of your employees employed for 8 weeks. So bottom line is to make this a handout instead of a true loan. You need to use 75% of it for payroll, and you got to keep your people on for 8 weeks. So that raises all these definitional questions about, well, what's payroll expense? How many employees? How do I count full-times versus part-times? Some of that I don't know the answer to. And in fact, probably your best source might be the lenders that you talk to. Also, as you know, the initial round of money for that was gone in about 12 days. Congress, the Senate has passed a new batch of money, about $310 billion. The House is poised to pass it as well. So in the very near future, a whole nother influx of money is going to be available for those PPP applications. And again, while I'm not really the right person to address all the details of PPP, if I were interested in getting one of those, I'd be calling my lender today to talk to them about when they anticipate how their process is going to work for applications and all of that. One of the wrinkles in this new congressional bill is that more of the PPP money is being earmarked for lending institutions that are small. The goal being to have more, community banks and small rural banks being able to get access to the money to then distribute to their customers to get it in the hands of ever smaller businesses. So if you have had difficulty dealing with your large bank, you might find it worth talking to a small bank as a potential place to go for some of this. So having said that, let's jump into some of those questions.
Yeah, why don't you expand, Brad, a little bit on what you consider salaries? If where's that 75% line? Is it employee salary deferrals only? Can the 75% include any other type of employer contribution? What's your stand on profit sharing contributions? Do you see a distinction between a stated contribution, employer contribution in the plan versus a discretionary contribution that doesn't have to be made?
Yeah, so the 75% payroll, that actually is a fairly broad definition. Payroll costs include, and I've got a quote here, I think this slide, hopefully you all are seeing, includes payment that in the employee benefits thing, it includes payment for the provision of employee benefits consisting of group healthcare coverage, including premiums and retirement. So the retirement is actually quite broad. And so one of the questions that was asked and that Treasury and SBA helped clarify, I believe on April 6th, was, well, does this include, mandatory contributions and that sort of thing? And it does. So payroll costs include paying for healthcare premiums. It includes retirement plan contributions. The question of mandatory versus discretionary has not clearly been answered to anyone's satisfaction. If I were you and the issue is repayment, or is this loan forgiven or not, and it comes down to, did I include discretionary retirement plan costs that I didn't have to make, I'd be kind of leery of counting that as payroll for this purpose, simply because there's the potential for them to argue, well, you didn't have to pay that. It wasn't really a payroll cost. You could have done that later. So really you were, sort of taking advantage of the program in an inappropriate way. We don't know that for sure. It's kind of a risk. What I suspect in practice is that you probably won't have too much difficulty using most of that loan for payroll costs without getting into questions that are on the bubble. It covers cash compensation for people up to $100,000 in salary. And for somebody who's over that $100,000 in salary, it still applies to their benefit costs. So the payroll cost can include up to $100,000 as well as the benefits, costs, the group health and the retirement benefits for that person. So, you think of that and you think of all the different employees. I doubt in practice it's going to be that hard to meet the 75% target. on payroll costs for most businesses getting this loan. But given that, I'd just be leery about getting there with discretionary contributions.
I think you hit on most of the questions that came in, including the $100,000 limit. One was very specific about a profit sharing contribution for 2019 that is discretionary, but it would be due now at the employer's tax filing deadline.
Yeah,
one question I don't.
something I'd be worried about, because on the one hand, you could say, yeah, this is compensation. On the other hand, they could say, well, look, the whole purpose of this is you guys can't even stay in business yet. You're going to make a tax preferred discretionary contribution last year out of money that you're supposedly using to keep your doors open. I just think there's a potential for a problem there. I don't know that I would want to go that far. But can I point to you a chapter and verse citation as to why you can't do that? No.
One of my favorite people on this call is asking if for COVID-19 reasons, a plan can now change from a 6% QACA to a traditional 4% safe harbor match.
Yeah, you can make those kinds of changes, but you are going to have to follow the normal rules for making some of those amendments. So there isn't sort of a get out of jail free card for just willy-nilly, reducing benefits or otherwise making changes. The special, you got a year and a half to fix the problems with a plan amendment. Those apply strictly to the distribution, loan, RMD provisions that are COVID related. They don't apply to all the other normal the normal things you might do to change a plan. So if you're able to make a change and you now have an economic impetus to make the change, that's fine, but you're still going to have to look at doing things prospectively, look at doing things in certain timeframes. So for example, some of the safe harbor issues, you might have to now face discrimination testing, but nonetheless, you might still want to reduce certain contributions, and the problems of discrimination testing are not as bad as the cost of doing those. The bottom line is you need to be creative on some of your other plan changes because you don't get a pass on the normal rules.
Brad, here's a question that we have been debating internally for quite some time now. You alluded earlier to loans having to be reamortized. When you mentioned that, are you talking about changing the payment amount, or are you talking simply about extending the same payment amount by the time that the loan was suspended?
Yeah, we've been having some fun looking at that as well, and we've seen some record keepers starting to offer interpretations which we think we can see how they got there, but it might not be our first interpretation. So I think there's a little flexibility here, but just as I look at it, what I think the intent is, and maybe we'll get guidance from the IRS that clarifies some of this, is that, okay, let's say I had a loan that was going to have 60 payments and I've made 56 of them, and now we're in this deferral period. There's going to be some interest that accrues because I'm not making any payments. So when the repayment starts, and one question is, does it start next April or does it start again in January? It's an interesting separate debate. But let's say it starts in January, just for simplicity. There was, $200 in interest that accrued during that period. I still have the same 5 payments left I would have had before because I'd paid 55 out of 60 payments. So I still have 5 left, but now there's an extra 200 in interest. What we think the reamortization probably means is there'll still be 5 payments, but they're slightly bigger than they otherwise would have to take that $200 in interest and allocate it across the remaining payments. That doesn't mean that's the only way to do it, and that doesn't mean that that's ultimately what the IRS is going to tell us. I think there's probably still some more to come on how that's going to work out, but that's one of several different reasonable interpretations of it.
I'm not sure I follow this question, but here it is. I don't know if this is a tax advice question. If all the assets that my client has are pre-tax, would you still recommend taking a distribution regardless of their need for cash today?
So I guess the idea is it worth incurring a income tax on that, let's say $100,000 if they don't need the money? Um, but that is a good tax question. So first I'm gonna tell you what, first I'm gonna weasel and then I'm gonna answer it anyway. So don't hold this against me. So here's my weaseling part. Really, that's something that would have to be determined by that individual and their qualified tax advisor and legal counsel, and I can't answer a specific case like that. I guess though, if I were done with the weaseling, what do I personally think about it? I think there's an argument to be made that if I can take a distribution and tax it over 3 years instead of having to pay in the same year I take out the money, that doesn't necessarily sound like a bad deal. If I were in the position where I could take a distribution even though I didn't need it, and it would save me some income tax because I get to pay it over 3 years, maybe that is good advice. I could see a scenario where that might make sense, but let's remember I'm an ERISA Title I lawyer, and while I speak tax, it's not my native tongue, and that's the kind of question I would ask my CPA.
I believe I have covered, Brad, and you actually have covered most of the questions that have come in, at least all the big topics. I know we're bumping here against the hour. Any closing thoughts or comment, something that we haven't as a group asked you that you've been asked before that you think you should share with us?
I addressed this earlier. There's I consistently, when I do events with plan sponsors on this, I consistently get the question of, what if we know our participants are lying or we think they're lying about whether they're eligible? And I'll just go back to, the law's given you an out here to not have to stand between them, unlike in a traditional hardship distribution. Take the out, make it easier on yourself, and don't question some of those decisions. Use the self-certification approach, and it'll save you some trouble. But more broadly, I think, and we have covered this, but I'll just repeat two key things. One, talk to your record keepers. Tell your plan clients to talk to their record keepers, because right now is a crucial time and they need to make some decisions here. And if they don't know what their record keepers are capable of doing or willing to do, it's going to really complicate things down the road. And secondly, please dot your I's and cross your T's on these ERISA matters. People are making big changes in labor participation for reasons unrelated to plans, which is normal and natural in this kind of circumstance. But don't forget the plans. It's going to be expensive and difficult to fix some problems that could have been avoided if we approach things a little more comprehensively. So when you're talking to your plan clients, you might mention that there's labor consequences, there's ERISA consequences. How you categorize someone that you're laying off, whether it's a termination, whether it's an unpaid leave, can matter. And if they haven't thought that through and they do one because they just assume they have to lay everybody off and terminate them, when they might be more advantageous for both the employer and those participants to put them on a temporary unpaid leave, those are the kinds of value-added advice situations that may prove useful for you in dealing with your clients. So I guess I'd leave it at that.
Thank you, Brad. If we did not get to your question, just know that we will get back to you by email. There were quite a number of questions that were very, very specific that just want to emphasize that if they're just a one-liner, somebody at Epic RPS will get back to you. Brad Campbell, thank you very much. Jim Wojak, thank you from Federated Hermes for putting this together. And obviously, thank you to all of you for being part of Epic Insight webinar this afternoon. As a reminder, we're going to be sending out a copy of today's slides along with a link to the recording as a follow-up. We wish you all safety and health, and obviously you support your families and your colleagues and your clients. Don't hesitate to contact any of us here at Epic if there's anything that we can do to support you. All our best to you. Please be well.